Thank you very much, Warren Mosler, for sharing these thoughts and comments and keeping the time. Our next speaker, Philipp Bagus, teaches economics at the Universidad Rey Juan Carlos in Madrid, currently the leading research center in the tradition of the Austrian school in Europe. I'm pleased and proud to add that he's also an associate fellow at the Liberal Institute. Professor Bagus has published widely in academic journals and authored or co-authored several books on economic theory and monetary and business cycle theory. Mr. Bagus earned bachelor's and master's degrees at the University of Münster in Germany and a PhD at the Universidad Rey Juan Carlos with the great Jesus Huerta de Soto as his advisor on a thesis on deflation. Professor Bagus is the author of two particularly influential bestsellers on the current financial crisis, one called Deep Freeze, focusing on Iceland's financial meltdown, the other called The Tragedy of the Euro, which was translated in over a dozen languages and is of special relevance today. Ladies and gentlemen, Professor Bagus.
Well, good afternoon, everyone. Thank you very much, Pierre, for your very nice introduction. First, let me thank the organizers, Fact Family Office, for inviting me. It's a pleasure to be here in Switzerland. It's a fantastic country, even though it's much colder than Spain, I have to say. But it has other advantages that more than compensate. Well, let me start. Okay, here it comes. So what will we see today? I will explain shortly the political interests behind the euro, how deficits are financed in the European Monetary Union, explain the difference to the Fed, explain what the tragedy of the euro is and its consequences, and then the future scenarios flow from there. So what are the political interests behind the euro? Well, before the euro, we had a fixed currency system with adjustable exchange rates. And in such a system, if you don't want to devalue, if you don't want to adjust your currency downwards, if you don't want to do that, because it's embarrassing and it shows to your population that you have done something wrong, that the others are doing it better. It's like a smoking gun that there is inflation. So if you don't want to do it, in such a system, you can only inflate your currency as fast as the member that inflates in the slowest rhythm, that inflates less. Who was this member in the European currency system? Well, Germany. The Bundesbank inflated less traditionally than others, so others had to adjust their inflationary policy, monetary policy, to the Bundesbank level, which meant less inflation, less monetization of government debt, less government spending, less power for governments that they would like to have. So the idea was to get their hands on these stubborn Germans and to get rid of the D-Mark and the Bundesbank. Well, the plans had been there for a long time. There was then the opportunity to speed up the process with German reunification when François Mitterrand asked Germany to give up the D-Mark in exchange for French permission to German reunification. Mitterrand said, we have to go forward with European integration now, meaning the single currency, because otherwise Germany will be a danger or something like that. So the euro helped then these governments to inflate more. It lowered interest rates on their debts, which gave them leeway to spend even more, to indebt them even more, and to stay afloat, because some had already very high debt levels. So these were the political interests, the main political interests behind the euro. So on the ECB, well, it creates the monetary base, and then the banking system can create money on top of that. They have the privilege to hold only fractional reserves. They got this privilege in exchange for their help in financing the deficit, as I will explain now. But let's look first on the Fed. So when the US government spends more than it receives in taxes, for the difference, it just issues paper where it writes on this paper government bonds. A large part of this paper is bought by the banking system. And then what does the banking system do with the bonds? Well, it can sell these bonds to the Federal Reserve and receives new reserves. And new reserves are very useful for fractional reserve banks because then they can engage, they have the possibility to engage in the very profitable business of creating money out of thin air, of credit expansion. Of course, the government then has to pay also interests. You could say, well, government at least has to pay interest on the bonds, so the deficit at least hurts in this way. Well, the government pays the interest on the bonds to the Fed. The Fed is the legal owner of the bonds it bought from the banking system. And due to the interest, then the Fed has a profit at the end of the year. What does it do with the profit? Well, you can figure where the profit goes. The majority of it goes back to the government. So it's a very nice way to finance your government expenditures. Actually, you never pay. You just print these government bonds, and when they come due, you reissue them again. And then purchasing power falls, and no one makes the connection that this is connected to government spending. If the Iraq war, for example, would have been paid by raising taxes, people would have protested much more. But if it's financed in this way, protests are limited. How does it work in the case of the ECB? Well, here's the same. If a government spends more than it receives in taxes, it issues bonds, receives money from the banking system. Now comes a difference, a slight difference. The ECB traditionally did not buy, supposedly it was prohibited, did not buy government bonds. So what do they do here? The ECB accepts government bonds as collateral for new loans to the banking system. In fact, it's a preferred collateral with very low haircuts in compared to other bonds. So the banking system only pledges the bonds as collateral and receives the reserves from the ECB and can then engage in the credit expansion process. Okay, interest have to be paid on the bonds. In this case, the bonds are still the property of the banking system, so the interests go to the banking system. But of course, the banking system has to pay also interest on the loans from the ECB, which are lower. So some of these profits here, in difference to the Fed system, remain in the banking system, and then the ECB remits back the profits to the governments. Here you see the percentage of the euro area debt in euro area banks, which is about 30%. You see in the US it's lower, which makes, after the explanation, makes total sense because the Fed directly buys these bonds. Therefore, there the percentage is lower. And yeah, there you can see how this has risen over the last years to more than 2 trillion euros. So what are the differences between the two systems? Well, economically, it's similar. It's basically the same. In both cases, the money supply increases, base money increases. In the case of the ECB, the money supply increases as long as the loan from the ECB to the banks is renewed, rolled over continuously. And in the case of the Fed, the money supply the base money is increased as long as the Fed does not sell it. So the legal difference is, of course, that in the European Monetary Union, the bonds remain property of the banks. They are only pledged as collateral, while in the case of the Fed, they are on their balance sheet. But in both cases, the government bonds are effectively monetized in the sense that new base money has been produced to buy these. So the question here then is, why did people only get upset in May 2010? In May 2010, the ECB started to buy directly government bonds, Greek government bonds. However, the ECB had financed effectively the Greek government long before by accepting Greek government bonds as collateral, which at the same has the same effect. It was more, it's just a symbolic step if the ECB goes and buys it, because it shows its support that it will continue to support Greece. This is the only importance of starting buying it directly. Of course, you may ask if 1/3 of government debts is held by euro area banks, where's the rest? Well, in banks that are not part of the European Monetary Union, UK banks, US banks, as currency reserves in central banks, foreign central banks, Bank of Japan, Bank of China, financial institutions that get incentives to buy government bonds, such as insurances, Solvency II, you get a lower risk on government bonds. So the incentives, they are driven to buy government bonds because there's regulatory privilege for them. And lastly, there's an indirect monetization that I will explain to you now. So here you see the picture. Let's repeat. In the European, or the government spends more than it receives in taxes, it prints bonds, the banking system receives the bonds and uses them as a collateral for new reserves. So this we had already, but now we are faced with the fact that the banking system has new reserves. So what does it do, at least under normal circumstances? Banking system expand credits, gives new loans, for example, to a construction company. So the money supply increases, credit expansion. The owner of the entrepreneur of the constructing company starts to build houses or build something and pays workers with the new money, newly created money, and other owners of factors of production. What do the workers do with the new money that has been created by credit expansion on top of the original increase? Well, they consume probably a large part of it, but maybe they also invest. Insurances, hedge funds, pension funds, etc. What do they do with the new money? Well, they will buy something that is very liquid in the market, that has also regulatory privilege. So some part of the new money will again end up buying government bonds. So this is the indirect monetization. They buy these government bonds because it's so liquid. Why is it so liquid? Because banks can always go with the government bonds to receive new reserves. If you have a government bond, it's almost as good as having cash, because the central bank is there to give you a loan in exchange for pledging it as collateral. So now, the second part of the story, that the EMU is a tragedy of the commons. What is a tragedy of the commons? Well, it's a special case of negative external effects or negative externalities. These effects occur when there's an inadequate definition or defense of private property rights. For example, a public lake. Everyone can pollute this lake. So if a factory throws its waste into the lake, then there are negative effects on others, on third parties. For example, someone who wants to swim in the lake, and then he gets some skin problem. So in the case of a tragedy of the commons, there are several people who can exploit one commonly owned resource, exerting negative externalities. Typical example are schools of fish in the ocean. Everyone can fish them. There are no private property rights in these fishes. So what are the incentives for any fisher? Fish as many fish as fast as possible, because if I don't fish, the others will come and fish. If they would be private property, then I would think in the long-term capital value of the school of fish, I would only fish as much as the school of fish could reproduce. But here, the incentive is to fish as fast as I can, because if I don't, the others will come. The consequence, well, an overexploitation of the resource. Fishes disappear. So why is the European Monetary Union a tragedy of the commons? Well, if new money is produced, there are cantillon effects. The first receivers of the new money, they always profit. Why? Because they have more money. The prices are still low. They are still all low prices, and then they start to spend. They can spend more than they did before, and then prices start to rise. They are second receivers, third receivers of the new money, and it extends through the economy. And at the back row of the economy, there are people who see that prices go up. Gasoline prices and so on, but their income hasn't increased yet. So they are the losers. The first receivers benefit on cost of the last receivers. So now, in the European Monetary Union, what is the commonly exploited resource? It's not a school of fish, it's the purchasing power of the euro. Why? Any government can do the following. Let's take the Greek government. The Greek government spends more than it receives in taxes, and for the difference, it prints government bonds that the banking system buys and pledges as collateral to the ECB. And they receive new reserves and expand credit. New money is created. And prices start to rise, or are higher than otherwise. So the costs of the deficit in form of higher prices are externalized on all monetary users. Prices do not only rise in Greece, but also in Spain, Italy, Germany, France. So for a Greek politician, look at the incentive. You can make promises to voters to win your next election, promising higher pensions and so on, by running a deficit, knowing that part of the cost of the deficit you can externalize on foreigners, foreign users of the same currency, on Germans, Italians, and so on. And the good thing is that Germans and Italians don't vote in Greek elections. So it's a perfect scheme for you. You can externalize the cost on foreign monetary users. And of course, not only the Greek government can do it, also the Spanish, any government that is a member of the European Monetary Union. And in fact, you can only win in this redistributional process if you do it more than the others. Imagine that Germany has a government deficit of 3%. It issues bonds that the banks buy, pledges collateral, the money credit expansion, the money supply increases. And the rest of the EMU has a deficit of, let's say, 10%. They also print government bonds, the banks buy them, money supply increases. Let's say prices rise average 8%. That means that the German government, even though they have a deficit of 3%, their real government spending may actually fall because prices rise faster than their spending. So you can only profit if you have a higher deficit than the others. It's the same with the fishers. If you fish faster than the others, then you profit. If you have a higher deficit than the others, then you profit in this redistributional scheme. It's the same We can imagine this, that we have here a printing press that everyone in the room can use. Well, let's say I would print, I would start to spend, prices go up. You could also print, and prices would go up. You only win here if you print more than the others. What is the effect? Well, there will be hyperinflation. Game over. So the question is, why is the euro still there? Which is actually the question that has to be explained. Well, of course, governments cannot use the printing press directly. There are some differences between the analogy and the actual system. Because governments, they cannot print euros, they can only print government bonds. And the banks have to buy them and pledge them as collateral. The ECB has to accept them as collateral. So there are two risks, basically. First, that the banks will not buy the government bonds. The second, that the ECB will not accept them as collateral. Well, these risks, however, have been considerably reduced, as we have seen in the crisis, because the euro is a political project. As Merkel says, there is no alternative to it. It has to survive. And the ECB has shown to be just a servant of politics. It has lowered collateral requirements. Greek government bonds are accepted, even though they are rated junk. Irish, when they were junk. Portuguese also. And now every country has basically a right to have their bonds accepted if they are rated junk. The ECB has also said they will provide liquidity without limits, unlimited liquidity. So even though these problems and the differences between the printing press are there, but they have been reduced. Maybe the strongest difference between the printing press and this scheme in the EMU is the danger that governments see that Germany could leave. If they have a deficit of 20% and inflation really picks up, then Germany might leave. This may be the main break on governments exploiting the tragedy of the commons. Of course, they had also a legal limit for it. That was the Stability and Growth Pact. Something like governments do with tragedy of the commons, for example, fishes. What do? They put quotas on the fishers. There are some people who are fishers, and they get so many tons of fish you can fish every year. Here it was so many, you can have a deficit of 3%. You can exploit this by 3%. That's the limit. However, it was more like a voluntary agreement between fishers. Like, let's fish only so many tons this year. There was no one to enforce it. So it was a complete failure. The Stability and Growth Pact was violated again and again, and is violated today. So the run for deficits still continues. The tragedy of the commons is in place. What are the consequences? Well, here's my book in the languages that are maybe relevant in this context. It's in German, Italian, French, and English. What are the consequences of it? Well, maybe the most important consequence is that it causes conflicts in Europe. Free trade leads to peace. As Frédéric Bastiat said, if goods do not cross borders, armies will. So free trade, like if Germans sell cars to Greece and buy feta cheese, there's a harmonious cooperation. They all benefit. They know that they depend on each other for this benefit. They live in harmony and are in contact, peaceful contact. Here, with the tragedy of the euro, it leads to conflicts. Why? Well, for example, if the Greek economy is very rigid, an inflexible labor market, too high wages, there will be unemployment. Okay, there's unemployment. What can the Greek government do? Well, it can, for example, pay, so they don't want a revolution, so what do? They pay government unemployment benefits. They send people early on retirement. Or they just hire the unemployed in the public sector, which grows and grows and grows. So, but this costs much money, and you run deficits, accumulate debts. So you, on the one hand, you can maintain the artificially high wages by this high government spending. But what effects do we have? We have an economy that is uncompetitive. We see this in the European South, that wages are too high. We have a huge government sector, unproductive government sector that sucks the blood out of the private economy. And as a result, you also get a trade deficit in these countries, because when the government has a deficit, issues the bonds, and the government gets the new money and spends it, prices will be bid up, but first in Greece. No? And when prices are very high in Greece, then the money will flow to Germany, to France. The prices are still lower. But then Greece gets a trade deficit. New money flows to the north in exchange for goods and services. That we have now. That the Mercedes is not paid by Fetashis, but it's paid by newly created money or debts that are never going to be paid. And then, but with the deficit, you accumulate debt. So at some point, so you have not only an uncompetitive economy, high deficits, a huge welfare state, trade deficits as a consequence. You have also an over-indebted economy. And at some point, we saw in Greece that markets lost their trust in these deficits. And at this point, Greece needed a bailout. And at this point, the monetary redistribution suddenly become obvious or apparent. Before, everyone was okay. No, Germans were just living. They didn't understand that there were Mercedes going to Greece in exchange for debts and new money. But at some point, they thought, oh, our taxpayer money is guaranteeing for Greece debt. We don't really want to maintain the Greek welfare state, the high Greek pensions and unemployment benefits. So suddenly, the harmonious cooperation of the free market, free trade, shocks with conflicts. That Germans say they don't want to maintain Greeks, and Greeks say, oh, but we think we now have a right to this welfare state, and the Germans want to reduce it, so Germans are bad, so we burn German flags and so on. So the euro supposedly was for the European project for peace. However, the result is exactly the opposite. It creates conflicts, the tragedy of the euro. The question is, how will it all end? Who's going to pay for the malinvestments? Meaning the debts that have been created, for example, the malinvestments in the Spanish construction sector that is now on the books of Spanish banks, who will finally, and the Spanish banks are now guaranteed by the governments, bailed out by them by Spanish government debt, who will finally pay for these debts. These are the private malinvestments that have been made public, but there's also the malinvestment in the welfare state. There has been public debt accumulated that financed people going for pension or retiring at age of 40. So who will finally pay for it? Who will pay all these debts? There are several logical options. First one is peripheral governments, reduce their power, reduce their spending, privatize their enterprises and their public property, sell the islands. This is one logical possibility. The other one is logical possibility is that core governments like Germany, they sell their public property, their public companies to pay for the debts, to pay the Greek debt, etc. Not very likely either. The third possibility is peripheral taxpayers pay. The taxes are raised in Greece, etc. Not very likely that this can be done to a large extent either. Core taxpayers, this is the option of the fiscal union, that we get a fiscal union in Europe and money flows continually from the north to the south to pay for, therefore, this huge welfare state and the deficits. The euros of the currency, that's the ECB option. Bazooka, more money printing, and the costs are spread of the debts to all monetary users in form of a loss of the purchasing power of money. Or the last one, financial institutions. Debt repudiation, government debt, for example, then banks suffer losses, banks are not bailed out, they are liquidated, or in the case of Cyprus, we have seen that this is also, in the case of Cyprus, also a loss for financial institutions. Stockholders probably will lose everything in these two banks, on the Cyprus banks, and also some of creditors. Bank creditors will also lose, and this is also an option. So who favors what? Well, France and the southern states favor option that there's a fiscal union, and the ECB does more. I hear this every day in the Spanish radio and television, or Merkel just stops us from doing something. The Germans stops the ECB from solving the problem, and they don't go forward with Europe, which what they mean is a fiscal union. They favor this. Germany, of course, favors other options. They want that peripheral governments privatize, sell weak islands, or privatize companies and reduce their spending. They also want that, which is counterproductive, they want that peripheral taxpayers pay more taxes. They have done this. They have raised taxes in Spain, for example. And Germany also always wanted financial institution banks to suffer losses. And the first time that they actually achieved this was now in Cyprus, which is actually a very good thing. So who will finally win of this side? You can interpret this daily news with this slide. The struggle between the two sides. So the conclusion is that the future of the euro and of Europe depends on who will finally win in the struggle on the debt payment, who will finally suffer the losses, because someone will suffer the losses. The question is who. And then, what will we do with the fundamental misconstruction? How will we solve the tragedy of the euro, that several independent governments can use one central banking system to monetize the deficits? Three possibilities we have here. One is we do a reform of the Stability and Growth Pact. I put limits for deficits at 3% or 1% or 0. Spain, for example, included this in their constitution. They have to have a balanced budget by, I don't know, 2025, I think. This is a theoretical option. The German government tells all of Europe that this will work, or that tell their population that they will have success with this, that there will really be public austerity in the southern countries. Of course, this option implies harsh public austerity, huge reduction of government spending. There is no public austerity in southern countries. Spanish government has spent almost 20% more in 2012 than in 2007. Last year, before the crisis. Last year, when still huge tax revenues were coming in from the housing bubble. In 2012, they spent 20% more, and they tell us that it's austerity? Come on. Of course, they have reduced a little bit spending on education and healthcare, but they have increased spending on unemployment unemployment benefits and interest rate on debt. And pensions, huge increase in pensions, the bankrupt pension system. So the first option requires real austerity and structural reforms. And this is the question, if this will be possible, if the population in these countries has been so used to what they call rights. In Spain, they call it always rights, that the labor market is so inflexible that they cannot be fired and so on. So they think that government is taking their rights where they have fought so long for. So with democratic governments, the question is if this will be possible. Second option is that the South and France, the eternal dream of the French political elite comes true. There will be a centralization and a European superstate ruled basically by the South. I mean, Germany would then sell this in the same way they sold the ECB. The ECB will be like the Bundesbank, like a copy. So the new European superstate or finance ministry will be enforce austerity on everyone and will be like the German model. But then when they will start voting and they give everyone one vote per country again, they will see that when they raise their hands, the Germans, they will be alone with the Dutch, Austrians and Finns. and Malta, Cyprus and Greece already balance them. And then we will see, of course, a transfer union, continuous fiscal transfers from the north to the south and ever more centralization, and harmonization, or how they will call it, of tax rates. So voting by feet will get ever more difficult. The last option is that the Eurozone splits. Why? Because the loser will be too satisfied. Here you see, if Germany then and the North wins, and there will be a reform of the Stability and Growth Pact that will be enforced, so a German-run Eurozone, and then the loser would be like Greece, Italy, Spain, and so on. And maybe they will be too dissatisfied by the situation. They will be a populist, and they decide to leave the euro. This is one option. More likely, maybe that the loser will be Germany. And in the German case, even though there are guilt complexes and so on, it also seems hard to imagine that Germany will stay in the very long run in a European fiscal union run by France that is high inflationary. So this does not seem really likely either. So now you have the different options, possibilities. You can make your own thoughts on this. You already see where I'm heading now. Thank you very much for your attention.